Taxation of insurance company. Taxation of insurance company. But even as we talk about taxation of insurance company, just remind ourselves of what concept of taxation is all about. Incomes against expenses. You have the taxable incomes, you less allowable expenses to get the taxable profit. And now the taxable profit are the questions that you are being asked and the tax liability. So with the same mindset, even insurance company, we need the incomes, we less the expenses. But there's something unique about life assurance business. So you can just highlight something as I try to explain. So for tax purposes, two types of insurance companies exists. Two types of insurance firms exist. Well, number one, we have general insurance business, and number two, we have life assurance business. So for general insurance business, we tax it just like any other business. You get the incomes, you less the allowable expenses. So for general insurance business, general insurance business is taxed just like any other firm, any other business. That is, allowable deductions, allowable expenses or deductions are less, are deducted from taxable income. So its taxable income includes we have premiums for the year. Less returned premiums. Kama kuna zingine ule return, inapunguza premiums zako. Their main income is premiums, their main expenses ni claims. Then we have number two, commission on reinsurance. Commission on reinsurance ceded. Commission on reinsurance ceded. So that is IE. That's the commission received. A commission earned for insuring other insurance companies. For insuring other insurance companies. Then hapo chini yake you say Commission on reinsurance accepted. Commission on reinsurance accepted is allowable expenses. Is allowable expenses, i.e. commission paid for being insured by other insurance company. Another one. Another taxable income we have claims used in reduction of premiums. Claims used in reduction of premiums. So this is about sometimes instead of paying the claims to our clients, unafaa walipe claims na kuna premiums wanafaa walipe, so you do some set off. Can have another one. Decrease in reserves for an expired risk. Decrease on reserves for an expired risk. Unexpired is this one. Unexpired. Hiyo ni kama decrease in provision for bad debts. Concept yake ni the same. Then hapo chini you say increase in reserves for an expired risk is allowable expense. Increase in reserves for an expired risk is allowable expense. Then you can just say any other income. Any other income that is taxable under the Act. Any other income that is taxable under the Act. So let's say something on taxation of life assurance business quickly. Taxation of life assurance business. Then you say it is associated with only two types of income. It is associated with only two types of income, i.e. number one, amount transferred from the life fund. Amount transferred from the life fund for shareholders' benefit. Amount transferred from the life fund for shareholders' benefit as recommended by an actuary. As recommended by an actuary. So an actuary, those people who value the premiums can recommend that some amount from the life fund can be transferred to be distributed to the shareholders. That amount will be a taxable income. Then number two, 30% 30% of the management expenses and commission. 30% of the management expenses and commission in excess of the maximum allowable. %30 of management expenses and commission in excess of the maximum allowable. Then you can say maximum allowable management expenses and commission, maximum allowable management expenses and commission are determined from the premiums. For the year which are subjected to the following graduated scale. Are determined from the premiums for the year which are subjected to the following graduated scale. So graduated scale inasema the first 5 million, unaicharge na 25%. First 5 million, 25%. So now remember, is the first 5 million of the premiums. Can even add here first 5 million of premiums. They charge na 25%. Then we have the next 7.5 million of premiums. Tulicharge na 22.5%. Inapunguka na 2.5%. So you look at how much were the premiums for the year. So those premiums you received for the year, tunasema kuwa the management expenses, the expenses that got the management team of the life assurance business, there should be some correlation between them and the premiums that you earned. So that correlation is where we say, if you overpay those expenses, you have to pay tax on the overpayment. So you have the next 7.5 million inapunguka tuichape na 20%. Alafu finally the next 10 million of premiums. Of the premiums, tuichape na 17.5%. Now, just to understand what is happening here, we need to derive a shortcut to this. So if your premiums exceed, this is 5 plus 7.5 plus 7.5, this is 20 plus 10, 30 million. So if the premiums for the year exceeds 30 million, then you know the first 30 million will fall on this. Because after this, we have the balance of premiums, which will now be charged at the rate of 15%. So before fike kwa balance, so let's just try getting these figures. 5 million times 25%. Ingine ni 7.5 million. Tuichape na 22.5%, 0.225. we have 7.5 million, which happen at 20%. Alafu ya mwisho ni 10 million, which happen at 17.5%. So meaning, by the time tunafika hapa, tutakuwa tumesubject a total of 30 million. 30 million. Na total ya 30 million of the premiums, the maximum allowable is this. So in simple terms, you are saying that we can go the shortcut. If your premiums exceeds 30 million, then you can simply talk about and say,
Happy birthday to you. Happy birthday to you. Happy birthday, little baby cat. Happy birthday to
so
you.
just a minute.
Oh, you. Thank you, sir. I love them. You know. Good. Good. You know. Happy birthday to you. Happy birthday to you.
So we can let's continue and see. So there we go. So we are saying that the 30 million, hii total ni 30 million vile tumeona. So meaning the first 30 million of our premiums, the maximum allowable becomes 61,87,500. So 61,87,500. So by all means, as long as the amount of premium has exceeded 30 million, we shall go the shortcut and say the first 30 million shall be equals to 61,87,500. Then you look at the balance. We look at the balance of the premiums. We have the total premiums minus the 30 million that you've already subjected them to, and that balance tunaicharge na 15%. So hiyo tutaileta hapa. And now that one becomes the maximum allowable. So we compare this maximum allowable, the management expenses and commission. So you compare it with how much was actually paid. If they paid more than that, the excess payment, 30% of it is subjected to tax. So let's see this question here. This question was tested in December 2021. December 2021, question 2B. December 2021, question 2B. So, Triplecom Insurance Company Limited is a resident company carrying on both general and life assurance business. The following information relates to the insurance company's business for the year 2020. We have general insurance and life assurance. Profit on sale of investments. You're not in the business of buying and selling investments. Kwa hivyo hiyo ni kelele. You only need the income associated with our businesses. Investments, we don't buy to sell. Investments, we invest in them to earn the investment income, not to sell. When you sell, it's affecting the balance sheet, not the income statement. So hiyo ni kelele. Then we have premium received in the year, premiums, that is taxable income. Commission ceded, that is an income. Premium returned, it reduces our premiums. Recovery from reinsurance company, hiyo ni income kwetu. Tumerecover some amount from insurance, this like reinsurance. Tulilipa na tumerecover. Premiums paid to reinsurance company, that's an expense we paid. Commission expenses, those are expenses. Management expenses, traveling, marketing. Fees paid to investment managers, those are expenses. Legal expenses relating to claims, that's okay. General expenses, that's okay unless iko na maneno huko chini. Bad and doubtful debts, we need to know kama ni specific, kama ni general, kama wako silent, we must make an assumption. Claims paid in the year, those are expenses. Bonus utilized in reduction of premiums, tulisema hiyo ni income. It can be bonus utilized, can be claims utilized, whichever name. As long as you are utilizing it to reduce the premiums. So badala ya kulipa the clients, tunabaki nayo. So that's an income. Claims outstanding for general business was holders have outstanding at the beginning and outstanding at the end. So outstanding is like an accrual, is a liability. And if we have an accrual at the beginning of the year, it means there's an expense for last year that we had not paid. So as we are paying the current year's as we are paying these expenses currently, there's one for last year that will also be covered. So, and that's where you're supposed to less it. When you have a prepayment at the beginning of the year, it means at the end of last year, there's an expense that you paid, which belongs to this year. So whatever the amount you're going to pay, will only be adding on what you had already paid. So what am I talking about? The accruals at the beginning you less, accruals at the end you add. Prepayments at the beginning you add, and prepayments at the end you less. So accruals at the beginning you less, at the end you add. Prepayments at the beginning you add because that's your income. Prepayments at the end you less. Yeah. General expenses under general insurance include cost of computers. Computers are fixed assets. Shall give it capital allowance. Saloon car ni fixed asset, taipea capital allowance. And now the saloon car, amount yake imepita 3 million, so you have to restrict. It's a non-commercial vehicle, ni gari ya starehe. So for the non-commercial vehicles, capital allowances are granted up to on a total that is up to maximum of 3 million. If the cost is above 3 million, then you have to restrict. Reserves for an expired risk for general insurance. Reserves at the beginning 3240, reserves at the end 6.2 million. So these reserves have increased. And an increase in reserves for an expired risk, tulisema that is allowable expense. The life assurance fund balance was valued by an actuary at 310 million as at 1st December 2020. 8% of this fund balance was recommended to be transferred for the benefit of shareholders. At the beginning of the year, the fund had been valued at 250 million. 10% of the surplus was recommended to be transferred for the benefit of shareholders. So meaning, kuna kwanza hiyo 8% of 310, tukianza mwaka ilikuwa 250 valuation, ikakuja ikakuwa valued at 310. So the surplus, nasema 10% of the surplus being 310 minus 250 will also be taxable income. Then we are told, outstanding premiums in respect of life insurance business were as follows. So ni outstanding ni accrual. Outstanding at the beginning we less, outstanding at the end we add. Other income received by Triple.com Insurance, interest from fixed deposit account. This is a company receiving interest. Interest received by a company from a financial institution or government security is non-qualifying, should be subjected to further taxation. So here it ends up other incomes. Dividends from qualifying companies. Hata wamesema ni qualifying. So the only dividends that will affect us are dividends that are coming from a cooperative society other than a SACCO. Company owns the building which houses its offices. Part of the office space is rented out to other tenants. 2020, the company received 2.8 million net rental income from their estate agent. Property management fees of 3.2 had not been deducted. Taxable income or loss for Triple.com. So let's see. So I start with our workings. And we need to have a working on life assurance business. Can we have premiums for the year? Premiums for the year. The amount paid during the year for the life assurance, I can see 100 million for hapa. We had some, I think, outstanding at the beginning. Is it for life? In a general. So we have 100 million. Kuna note number 5, outstanding premiums in respect of life assurance. So we less, can actually do it here. We less the outstanding at the beginning, which is 12,000. Then we add outstanding at the end, 9,200. Good.
Papa. Iski, Baba. Today is ski.
So you have 97 million. So the 97 million, we subject them to the graduated scale rate, graduated scale rate to pale juu. So out of this amount, out of the 97 million, we say the first 5 million. Can you just say the first 30 million? The maximum allowable between 6187, 500. Because out of this is already 97. And this car working here covers the 30 million. So 30 million are here. So look at the balance. We look at the balance, which is 97,200 minus 30 million. And this one, we chapa it at 15%. So 30 97 200,000. So there we go. So that gives us maximum allowable management expenses and commission, any commission paid to the management, which will be the total of these. Now we look at that, then you compare the management fees that were paid on life assurance. So you have the management expenses here, which are running 25 million. I don't see any other cost that went to the management. So any expense that goes to the management, it should not go beyond 16,275 as far as this insurance company is concerned in this year. So therefore, we come and ask ourselves, what were the management expenses paid? And the management expenses paid from our books can see 25 million. So can we have excess payment? Which will be 25 minus these. So therefore, hiyo working ndio inasumbuanga tu. So let's see. So let's have Triplecom Insurance. Triplecom Insurance Company 2020 taxable income computation. They can start with the general. General insurance. So I shall log in again if it goes. So general insurance business. Can we start with the premiums received in the year? So premiums for the year. So we received premiums of 15,450. 15,450. I'm not sure if we have any return, any outstanding in your claims. So I have premiums for the year, which is 15,450. With less returned premiums. So returned premiums niliziona mahali. Premiums returned 375. So therefore we have that. We less the returned premiums. Commission seeded, that is an income. Commission seeded, that is 8,000. Return premiums, we've dealt with them. Recovery from reinsurance company, that's an income. Recovery from reinsurance company, 1,200. What tumelipa claims na tukarecover, karudishiwa after reinsurance. Premiums paid to reinsurance company, that's an expense. So leave some little space. We kill the two birds with one stone. So we less allowable expenses. Among them, we have premiums paid, for reinsurance, that is 7680. $7680. Commission expenses, those are allowable expenses. Commission expenses, $1050. After commission, we have management expenses. For general, management expenses, 2034. Traveling expenses, so traveling expenses, that is 1,200. Marketing expenses, 414. $314. And we have fees paid to investment managers as an expense that was paid. So fees paid to investment managers, 900. Legal expenses on claims, legal expenses on claims, that is 740. General expenses, iko na note number 2. General expenses. So as we show our workings there, out of the total general expenses of 8490, tutoe 800 of computers, na pia tutoe saloon car 3260. So we remain with 4430. And we can also have now, because we've talked about computers, we can have our computers, we give them the capital allowances. So computers, class yake pale kwa leakage is 25%. So 25% of 800, that is 200. 800 divided by 4, that is 2. And then computers, we have saloon car. Now saloon car, it's also 25%. 25%, but because it's a non-commercial vehicle, as we said, this amount has to be restricted. So the amount is in excess of 3 million, so we restrict it to 3 million. Alafu hapo juu yake unaweka R to show that you've restricted. Mbele yake tu hapo. So this 750. That's 750. Add debts, bad and doubtful debts, no information about them. We can assume it's general to make our life easier. So that hapa tuweke dash. If you assume they're specific, then you have to put those figures there. But hakuna haja ya kujitesa na kazi mingi na uko na alternative option that is easy. Claims paid in the year. So you have claims for the year. The amount paid during the year is 9,800. Note number 1, we had outstanding at the beginning, which we less. That is 6640. Then we shall add outstanding at the end, which is 7,000. So those are the claims. Bonus utilized in reduction of premium inakuja kwa incomes pale juu. So bonus used to reduce premium We used a bonus of 180. That's an income. Let's check huko chini kama kuna kingine kimebaki. So claims, general insure expenses, reserves, we've taken care of that. Number 4, life assurance. Number 5, outstanding premiums to share deal nazo. Other incomes itakuja baadaye. So we have our gross income. You have our gross income. And we less the allowable expenses. So there we go. So we have taxable income, which will be incomes zako less expenses. So this income is actually carried forward. This is a loss carried forward. Then now we bring in other incomes. Other incomes. Now, among other incomes, you have life assurance business. For life assurance business, we have amount transferred. Amount transferred from life fund. So the life assurance fund balance was 310. 8% of this fund balance, so you're having 8% of 310,000. Kuna ingine tena ilikuwa transferred. 10% of the surplus. Surplus becomes 310 minus 250. So 10% of 310 minus 250. So that is 6,000. 10%. The difference is 60 years. 6,000. We also have 30% of excess management fees and commission, which is now 30% of The excess management fees tulikuwa tumezipata 8732.5. Hope you are all seeing that. 8732.5. So you have that. So that becomes that. So equals this plus this. So equals to this plus this plus this.
Tutoke namba 2 tuzasemia na after 1 year Geti anazaa mtoto mmoja. Sasa hii Geti analipa na zaidi yake.
So there we go. Other than that, do you have any other income for this company? Note number 6, interest from fixed deposit account. Interest from fixed deposit account, FDA. So interest of 780. Hawajasema ni net, kwa hivyo ni gross. Wangesema ni net, tunge add back the withholding tax of 15%. Tungefanya times 100 over 100 over 85. We have dividends from qualifying companies. So tunaandika tu for the sake of getting marks. Dividends from companies. Not there. Then we have rental income. Rental income. Do we have net rent? Company owns the building. Part of the office space is rented out to other tenants in the year. The company received 2,800 as our rent. From the estate agent, property management fees amounting to 3,200 had not been deducted. So we less property management fee. Property management fee, which is 3,200. So the difference, these minus these, it's a negative, kwa hivyo inakuwa loss carried forward. So huku kunakuwa na 0. Hata hii, now, so therefore, kwa sawa, our total taxable income. Our total taxable income becomes easy to. You can never tax a loss. Can never tax a loss. And that's why this loss tuna ignore. A loss from one source cannot be offset by incomes from other sources. So that loss we wait for next year and see if we shall make profit out of that business. So we offset the loss and the balance is what is taxable. So I think that is it, unless there's a question. The subsequent months. Sorry, so you're saying that when one source makes a loss, then that loss has to be carried forward. You cannot offset a loss from a business against an income from rentals. The government will remain poor. So it allows you to carry forward that loss to the subsequent years and try to generate some profit, try to offset that loss against the profit from the similar source in subsequent years, and they go up to the 7th subsequent year, up to the 6th subsequent year, so that the total years become 7. So even for the rental, we are making a loss of 400. We cannot allow this 400 to come here. Ikikuja hapa, itapunguza profits zetu. The same case here. We cannot allow this to be part of all these, because when it comes, it will reduce our profits for tax purposes, si kama KRA. And we don't like that. No. That fine?